clearly yields have picked up quite noticeably apart from yesterday over the last 10 days or so. Is that start of a much bigger move higher?
Well, I think so. We've been in this range for a while, and it's been extremely muted when it comes to rate volatility within the 10-year and the 30-year Treasury market. Obviously, the front end of the curve is pinned down by the Fed commentary. But, you saw somewhat a knee-jerk reaction in bond yields after the Jackson Hole Symposium, where the Fed, as expected, announced some form of new type of inflation targeting. And so essentially what the Fed has signaled to the market is that we are going to try to create a steeper yield curve. We're going to keep the front end of the curve depressed. We're going to keep it low. We're not going to raise interest rates, although there is that dependency on the economy that you guys are referring to. But in general, the idea that they would be willing to let inflation run a bit hotter over the medium term than historically have done so signals that they're willing to let the bond market on the back end of the curve, 10s, 20s, 30s, to go and drift higher. And that's what you've seen really since the announcement of that. Yes, there was a dip down a little bit yesterday, but we seem to have somewhat resumed that trend here. So the one thing we just really don't like at these levels is the back end of the yield curve, just simply because of that inflation targeting. And further, it's hard to see a lot of protection from the bond market, at least in treasuries, if there is another risk-off environment. So right now we remain cautious in the back end. We've continued to remain underweight duration for the time being, and we'd like to see how this range goes and see if we can actually truly break out of it.
So Jeff, even if we don't get a stimulus, do you still think the 10-year, the 30-year will be a lot higher than they are in terms of yield this time next year?
Well, I think even without a stimulus, because we are in the world of stimulating through fiscal spending, irrespective of if there's a short-term stimulus or not. So recall prior to COVID, we were running or expected to run north of $1 trillion deficit. And then obviously COVID has changed the rules with the CARES Act and like. So even without the short-term stimulus prior to the election, I do think that the path is higher deficits. There will be the requirement to do some form of transfer payments from the government to the workers out there unless we get a really strong recovery in the labor market. And I think that's what some of the risk markets are really sloughing off at this point in time, is that we still have a lot of irreparable damage within the labor market. You still have, assuming that the pandemic unemployment assistance numbers as well as the continuing jobless claims are not overlapping, roughly 25 to 30 million people that are still unemployed. So we need to see improvement in that part of the market. And the way to improve that, just listen to the Fed chairman. We need for some form of fiscal stimulus. The chairman has been saying this for 3 to 4 months. And if you look inside the notes that released or the minutes that released today, you see exactly that same behavior. Their forecasts of this resumption are predicated on there being more stimulus from the fiscal authorities.
Shepard Smith here. Thanks for watching CNBC on YouTube.